Ladies and gentlemen in the crypto space, we're live on a Friday, December 16th at 10:32 a.m. We're a little early today. We're going live at 9 a.m. Pacific time and 12 p.m. Eastern time with Curve Cap Lens, which is pretty cool. Obviously that is a protocol of interest to me and many others, and that is likely going to be one of the core topics. I don't really talk about what we engage with. I mostly talk about the system directionality and obviously today's topic, liquidity, to understand pressures in the system where capital is flowing. Because if capital is flowing and there's liquidity, everything gets bought. It encourages allocation, it encourages the purchasing of things, it encourages investment. And the topic of today is the state of that liquidity and what the opposite of excess liquidity means for pricing and valuations. We all know how that plays out. So let's pop it over to the main screen, and I have three things we'll talk about. This is M2 versus M0. So M0 is base money. That's the amount of dollars that exist, period. And this is not a perfect chart because M0 is adjusted, but what it is depictive of what I wanted to express, which is the degree of change. And this visually shows that M0 has come down a fair amount more than M2. So M2 is basically a derivative of M0. So you have dollar bills, $100 bills. You have currency units, actual the quantity of currency units that exist, period. And M2 is a combination of deposits, and it's basically the leveraged form of M0 that results from loans and lending and capital expansion and all the stuff we talked about over the last couple of years. So if M2 is kind of collateralized, no, it's or the ultimately everything reduces to the amount of currency units that exist, and if the amount of currency units that exist has reduced much more than the derivative currency units that are in circulation, that's likely to encourage, or at least it's highlighting a discrepancy, a divergence that M2 should really trend with M0, and if it's diverging, that's a risk because ultimately you need M0, you need currency units to manifest the M2, and if there's less currency units, the synthetic currency units are chasing fewer of the base currency units. So how do you prop up M2 if you have less and less base currency units available to work with? And this is a negative sum game. There's less. It's not like it's flat. So the leverage and loans and currency creation processes are working with less and less currency units. So this is depictive of a pressure of a deflationary pressure. This disinflation is a deflationary pressure, forcing contraction. Now, this is a very interesting topic. It's very complicated, and obviously, folks were interested in crypto markets, but I talk about crypto markets as an emerging market, so to understand the potential in this specific market, we really need to understand capital flows, how it flows to and from sovereigns, into and out of the United States, and this data is obviously related to the dollar, but the dollar is, the majority of global currency activity. So this gives us a good, decent, or a reasonable picture of what the hell is going on in global financials, and obviously the cumulative effect of rest of world currency liquidity, just like we're looking at US centric, does have an impact on overall behavior of the global financial system. But we're not going to dig that deep for now. We're going to focus on the dollar. And with regard to US domestic, the reverse repo market has a significant impact on the available liquidity on U.S. domestic dollar denominated currency availability, liquidity availability, and we refer to Arthur's chart often because it's meaningful. Um, Liquidity's up, so as liquidity is disinflating, we have the depreciative pressures that we're experiencing. So we see this transitory support. So we don't see the bottom falling out. We see support hitting support. If we go over to the S&P, we're sitting on the 50 SMA on the daily. Now, obviously, this looks like shit, but and support hitting support is a position of weakness. It's an expression of weakness. There's no strength in support. There's a resistance flipping support. Then the higher high is the trifecta of bullish confluence. There's an antithesis to that, which is resistance, support flipping resistance on the lower low. So we're not there yet. We just have a support hitting support situation, but this looks absolutely horrible. But the reason the support is there is because there's liquidity in the system. And what do you do with that liquidity? You own different things, and we as retail don't have the same consideration as institutional capital managers, and capital needs to be deployed to one thing or another, either for purposes of opportunity or purposes of prospectus and other types of mandate. So we see the expression of support here because there was a bump in liquidity. I haven't dug too deep. I don't know what the reverse repo participation is today. It's probably still over 2 trillion. But I did pull up an interesting chart. Where was it here? I posted it on Twitter a little bit ago. Now, the amount of capital in reverse repos is a negative factor in domestic systemic liquidity. So this chart is interesting because it's the reverse repo rate minus the 1 month short-term bills that banks operate on. You can do this with the 2 month as well, and all the way up to the 1 year to get a sense of how the reverse repo rate corresponds with collateral that the banking system is interested in. Now, when the reverse repo rate is greater than the yield on short duration instruments, the actors are going to favor deploying capital to the reverse repo market, which is a drain on systemic liquidity. But we see that this is cyclical. Last month, we had obviously the market conditions favoring deploying capital to 1 month bonds, 1 month T-bills. And that drove liquidity into the system. So we're at the point of peak reverse repo draining, at least relative to this relatively short chart. In 2020, we had a spike, but look at this increase in volatility. I guess this is representative of overall bond market volatility. So the volatility has picked up significantly in 2022. Most present or most visible in this chart in February of 2022. And this volatility increases fear, and people take less risk. And this is what induces risk off. Obviously, we did not have the repo market volatility. We had activity, but look at the rate of change. There was no volatility up until this year. So this is actually an interesting chart as long as the reverse repo facility continues to exist to get a sense of a meaningful pressure that discourages capital deployment. When there's volatility like this, there's not going to be liquidity being deployed because what if a rate of change on a rate of yield on an instrument is changing, you could be like, what do I do it or do I not do it? Is there going to be a more favorable position to emerge? And that's what induces the uncertainty. So it would be interesting to see if we have any of these large spikes. Bear in mind, this is a giant wick on the daily. So this is a ceiling thus far, at least from a technical perspective. What the technicals indicate on this chart is a conversation unto itself. But if we're at a ceiling and we start to see a topping pattern, for what it's worth, what it is, I don't know if the patterns are meaningful in this type of spread, but obviously it's cyclical. And if it comes back down, we could see a meaningful increase in liquidity as the banks will find a greater return with short duration government securities as compared to the repo market. And that could drive upwards of $2 trillion into domestic systemic liquidity. And we see that to some degree here. This is an aggregate because this is uh, um, Fed balance sheet minus reverse repo participation and the Treasury general account. So as the reverse repo participation comes down, if it has to come down faster than the Fed balance sheet, which is obviously the case because we're up 500, half a trillion dollars, close to a half a trillion dollars, and there's your liquidity, and that's why we see support in the market. It's as simple as that. If you see bond, and this actually introduces support for the argument that correlation between risk on in the bond market and risk on in equities remains. As liquidity goes up here, it's because reverse repo participation is down, which means the banks are deploying to short duration government securities, and that is ultimately manifesting in the support we're seeing in the equities market. It's not a crash. It's not like straight down. We're not seeing 500s come off futures or 5,000s come off the Dow. Um, so we still see that correlation. And let's take a look at the long end for the fun of it, the 10-year. So S&P is breaking through support, and if we look at, do we still see correlation? Well, it's resistance, and this is on the daily. So let's look at what we're on. We're on the daily. So it's not like we have risk off right here. So, my interest is to see if the correlation is holding. Um, we would want to see further depreciation in 10 years yields throughout the day, which would indicate price appreciation of the instrument to correlate with support here holding on the 50 SMA. If we see that, we still see some sort of correlation. Now, obviously, there's plenty of reasons for risk off, and lead lag. Michael wants to see the traditional risk off emerge, where you have the inverse correlation between bond pricing, particularly long end, and depreciation in equities. So, anyway, we're digging into liquidity. I had one other chart. We talked about that one. No, we talked about all three. That's why we see a little bit of support. That's not why we see just literally a straight line down. But let's go out to the weekly for the fun of it. Oof, still above the TWAP. Now, this is support. You guys now know how I talk about support holding as support as a position of weakness. Dan's in the house. Tapsy's in the house. Lucas, a pleasure. Dark in August, good morning. Any interest in Thorchain? Yes. With Ren getting hammered by FTX. Yeah, I know what it does. It does the same thing as what Ren does. Um, yeah, I have interest in plenty of things. I have no interest in taking any risks in this market. Um, that's my biggest consideration is just cash. And we had fun over the last 2 years, and we have large asset portfolios, and it's not really a traditional asset, and that's a good part of what I'll talk about with curve cap. But it's also what we talk about here with these abstractions and this modeling that we do to understand these systems that we interact with. They're not traditional positions. Technically, we don't even own assets. We've deposited them in positions that we've given up control. In many regards, it's an arm's length transaction, which is an interesting conversation unto itself. for years, and that entails what we're dealing with here is something new and novel, and these positions produce cash. So, I know it's boring, but the extent of what I must talk about is how I handle these markets, and there is just way too much risk to be deploying meaningful amounts of capital. I will say it now, and I'll continue to say it, that we are grateful for the activities that we were able to engage with over the last 2 years. I am grateful for the positions that are locked, that are productive. They are simultaneously a speculative bet on future liquidity conditions in the market. We're looking for attributes of survivability. If it survives, they will be increasingly lindy, and then capital through these protocols will entail continued and likely increasing returns. And this is a period of time where it's melancholy. It's boring, and that's okay because we're grateful to have a claim button on a weekly basis, and obviously that claim button will be proportional to how well folks have done over the last 2 years, and it could be quite meaningful. There's folks that are pulling in tens of dollars, hundreds of dollars, thousands of dollars a week. I know folks that are pulling in five figures, six figures a month, and that's wonderful. And we don't count other folks' um, cards. We you can only play your own hand. This is poker in that regard. Um, you have to play your own hand. So anyway, that's my sentiment. Um, Rupert's in the house, a pleasure. I was just happy to have a non-exchange way to use my USDC to buy BTC. Yes, with regard to having an on-chain capacity to purchase Bitcoin or to trade or transfer, purchase Bitcoin, yeah, it's very effective. Obviously, you could go through BitGo and WBTC. Um, that works from a centralized implementation. I've used that. It's very effective. And it's as simple as that. So that's pretty cool. So you don't have to go through the centralized exchange process, and that it's nice to have everything on chain because from a reporting perspective, it's all there, and that's refreshing. That's not so, when you're dealing with transaction history printouts from multiple sources. One, you have to remember actually the protocols that he interacted with, and that's so annoying. I went through 2020 and 2021, and I had no recollection of the shit that I did. And I'm like, could we find it on chain? And it wasn't so easy. So it's nice when, especially for me this year, a big focus was just on chain, and that allowed me to concentrate all of my reporting literally to QuickBooks. So this year I have everything I need in a single export from QuickBooks. I don't need any of that, any of these companies that are offering sophisticated tax reporting analysis of on-chain activity, whom I think really go into way too much granularity. And I think they operate very much as a business, and they want to sell a product. And I don't think a lot of what they offer is absolutely needed. I think we have a capacity to effectively and correctly report in a very much more simplified way. And QuickBooks is very effective at depicting a balance sheet, inflow versus outflow, just as any corporation would handle a balance sheet, and just balance the books. And if everything is reported in income versus capex, there you go, business reporting. Um, I'd like to deal in native assets, learn from Harmony Bridge Hack. Yeah, I don't have any liquid assets on anything other than mainnet. Um, Most of the time, income from the other chains is sparse. Um, I would bridge it back to a USDC on mainnet. Um, I keep it on mainnet. I know the bridges are worrisome, and exposing to them certainly is risk. So avoid exposing yourself to bridges. Stick to mainnet, and Arbitrum and optimism, and there's degrees of risk there as well. But anything the closest you are to mainnet, the more comfortable you'll be able to operate. Hope layer zero will address the bridge security problem. Yeah, well, that's the beauty of layer zero. It's not a bridge. You're talking about assets on both chains, and layer zero facilitates messaging from one, chain or roll up, or so on and so forth. And that messaging is what executes the swap of value from one chain to another. So it's not a bridge. It's a whole other ballgame. So layer zero is very interesting. The tokenomics aside, there's still meaningful transaction volume, and this certainly this period of austerity is not favorable of even a great set of tokenomics. Um, good part of there's a lot of folks that are very interested in the derivatives protocols, the options protocols, and I am as well. Um, we mostly talk here about the base layer, the forex market, the capacity to exchange assets and extract the transaction fee. Um, what's my point of that statement? I guess my point is, you know, I like uh, I like that concept on Arbitrum and optimism, and I think that's going to be my continued focus. Okay, here was the point. The point was, how do you get through this period of austerity? It's the tokenomics, and even a great set of tokenomics is going to get hammered. So there's two protocols that are iterating on the tokenomics actually, and that's Tapioca. But we did see an interesting post from IPOR. Um, and I found that quite refreshing. Anytime I see someone talking about an iteration on and referencing the status quo and referencing curve and referencing maybe aura and balancer, and that's what you want to see to what has the potential to to have the attribute of survivability in market conditions like this. And obviously the precedence for like derivative protocols is probably like a GMX. That's the most successful, but I will refrain from engaging outside of my what most interests me, and that's governance and cash flow atop either collateralization, CDP, stablecoin protocols, and forex markets. So as much as maybe folks, clearly not as many folks watch me in this very much period of austerity, 18 folks on the stream, 2 likes, we could do better. There are the things that do excite me, and I am very excited for Tapioca's tokenomics model. And IPOR piqued my interest. Oh, and Solidly's launching on mainnet at some point eventually. Yeah, everything I've always thought about Solidly is still the case, even though it absolutely, completely separate and apart from its debauchery of a launch. That doesn't mean anything with regard to what it wanted to do. And if they could actually achieve what they wanted to do, it's very interesting. So Solidly should be better performant as compared to Velodrome. Velodrome will be playing catch up because Solidly is iterating atop the original implementation, and this is cool. So Velodrome is interesting, but there's no need for me to deploy to it because Solidly is deploying to mainnet, and we have the legacy burn positions that'll carry over. Anyway, I'm just chatting at this point. I'll be talking with CurveCap Lens at 12 o'clock. I'm sure we'll post links on Twitter. If I haven't, I'll do that after this call. And, that should be a good topic. We talk about, on this stream, I try and avoid protocols, and I have no interest in not even the antithesis of convincing anyone to deploy capital. In fact, I mostly encourage people to be protective and understand and appreciate what the hell dollars are, the global financial system. And it'll be a nice chat where I get to talk about what folks ask, and we'll be talking about Curve And that's always a good topic that I don't get to talk about on the stream often. Anyway, 21 people in the stream, 4 likes. Thank you all for joining me on this Friday. I know it's been quiet as this market continues, and I missed the 3 days a week. Do you believe I used to do 5 days a week for like over a year? Wild times. What absolute liquidity, just flood of liquidity does to people's behavior. So, but we'll keep it up with the 2 days, and I'll keep you guys apprised of what the hell's going on. At least if we have a liquidity event, I'll see it, and hopefully we have some support, and the reverse repos certainly offer that. But what do you say, Danny? How do you feel about DigiCorp Lab proof of concept with Shell Oil? Does it pay? So here's the deal. So great tech does not always make a great investment. And this is my thesis. This one tweet, it represents how you actually do well in markets. You want me to invest in your company, which is buying a token, buying a stock, so on and so forth. How much are you paying me weekly? Zero, but the growth of the stock price. So I'm going to buy something and the stock price is going to go up. And that's what you're going to pitch to me? No, fuck that. Fuck you. Pay me. Pay me weekly. Cash. So I can buy egg sandwiches at the store. So I still love Digibyte. I like what's, I did go to Washington and I talked to some people to try and encourage them to think about the potential for the UTXO blockchain, which is meaningful. Uh, Very cool. Proof of concept, technology, even DigiID still is very interesting. But from an investment standpoint, it's a non-starter. I would define a lot of investments as uninvestable merely because of this tweet that you see on the screen. I could give a shit if something has the potential to go up in price, as long as it pays me on the weekly. Get paid. Fuck you. Pay me. And now I believe, based on everything I've learned, this is the most important thing if you want to have something sustainable and meaningful with regard to what you own that will impact your life on a daily, monthly, yearly basis. You buy things that pay you so you could go out to dinner, that you could buy things at the supermarket, that you could put gas in your gas tank. And if you deviate from this, you're heading down the road of risk and uncertainty about, are you even going to get your damn money back? Fuck you, pay me. Ha! Very simple. Anyway, I hope that helps. So yes, Danny, I like it, but this is the deal. Joe, seems like LPs. I was going to wrap up the stream, but I'm not going to leave any of you hanging because that's how I do things. Seems like LPs provide more revenue than staking native tokens on protocols for fees and bribes, with very few exceptions. Well, I want to own the cash flow of the entire protocol. So over the years, you would think that there's going to be more LPs, there's going to be more tokens, more protocols, and they're all going to have to get funding, and they're going to have to purchase liquidity, and they're going to probably want to do that in a capital efficient way. So I want to own those systems. I don't want more revenue. I want less. But I want the revenue source to be from the overall system. So when other protocols are forced to engage over the next 10 years, the overall system will be more profitable. I want to own the system, not just a specific component of the system. You wonder how the protocols service that debt. Well, you got to balance the books, and it's not necessarily debt, because a lot of these protocols are cash flow positive, and that cash comes from users that are spending and paying interest on debt. So clearly, we're in a negative sum game with decreasing liquidity in the crypto space, which means every person still acting in the space is chasing fewer and fewer currency units, which means this is a game of winners and losers. There is predatorial behavior, and this is all understood. But as long as the balance sheet balances and capital is flowing, there will be revenue streams of, and that's meaningful. And I want those revenue streams. Second set, cash flow above all else. Yes, indeedy. And there's few sustainable cash flow sources. You could probably put it on your 10 fingers. Sounds right. Thanks. You're welcome, Danny. I hope it helps. I know I have no hopium. Zero. There will never, ever be hopium on this channel because that is what burns people. That is what hurts people. Because if one person it doesn't work. There's no miraculous thing where every person engaging with the protocol isn't a predator. So therefore, you must assume everyone's a predator, and that's exactly what we see historically with asset pricing. Look where the asset prices are now. They've been predatorized, predated. I don't know, something like that. Let's make up some words. Happy Friday, Brian. Thank you. Dark and August, I appreciate it. Friday, December 16th at 11:03 p.m. I wish you all a wonderful weekend. Thank you all for joining. Tell everyone to subscribe because I can't help people if they don't listen. You know the deal. After party on Discord for the most rational community in the entire crypto space. I will see you guys at 12 p.m. with Curve Cap Lens. Catch you then. Peace.